Welcome to the week that was, our deep dive into, well, what a 7 days it's been for digital asset markets.
To say the least.
Volatility was absolutely the name of the game. We started the week with what looked like a textbook relief rally, fueled by some pretty compelling macro news.
It did.
But we ended with a swift, almost brutal technical collapse that dragged the price right down to 6-month lows.
And this week was a total masterclass in institutional conflict. I mean, the core tension we saw was just this immediate, really intense divergence between what we'd call fast money.
So that's the capital in easily liquidated things like ETFs.
Exactly. That money was aggressively exiting. But at the very same time, you had strategic money, the long-term, more sophisticated players.
You mean the opposite?
Actively accumulating. So we aren't just looking at a sell-off here. We're really documenting a high-speed transfer of assets from one group to another.
So our mission today is to unpack all this chaos for you. We need to identify that dual catalyst that launched the rally in the first place, track that really astonishing institutional whipsaw we saw in the flow data, and, I think this is crucial, isolate the long-term structural developments that just kept moving forward this week, completely indifferent to all the price turmoil.
Right.
So let's start with that brief moment of optimism.
Okay, so the week began with Bitcoin staging a pretty important technical comeback. It rallied about 4% to reclaim the $106,000 level.
And that move was structurally significant, right? It wasn't just a random bounce.
Not at all. It resolved a period of high uncertainty, what analysts were calling an unstable equilibrium, and it resolved it decisively to the upside. So it essentially invalidated all those immediate, pressing, bearish scenarios people were worried about.
I remember seeing that. The initial strength was built on a really specific technical victory, wasn't it?
Yeah.
Successfully closing the weekly candle above $104,500. Why did that specific level matter so much?
Because that close validated the 50-week exponential moving average, the EMA, as a critical support floor.
Okay.
Think of the 50-week EMA as the market's long-term heartbeat. When the price holds above it, it suggests the fundamental trend of the market is still intact, despite any short-term noise. That was the base, and then it gets some immediate fuel.
And that fuel came straight from Washington, D.C.
Yeah.
It neutralized what had been the primary systemic risk on everyone's mind, the 40-day U.S. government shutdown.
That's right. I mean, the moment the U.S. Senate voted 60-40 to advance that continuing resolution, it just neutralized fears of a major liquidity drain across global finance.
Everything jumped.
It triggered a coordinated risk-on pivot. We saw a NASDAQ 100 futures surge, and Bitcoin just moved right along with it as part of that global liquidity injection.
What's interesting to me is how quickly the sentiment caught up. The rally climbed what analysts call a wall of worry, moving the crypto fear and greed index from 22, which is extreme fear,
right,
up to 29, which is, it's still firmly in the fear category. People were not rushing back in.
Which is actually healthy for a sustainable uptrend. But what really stood out was the fundamental flip. On-chain apparent demand, which is our key metric for new capital entering the space. It increased sharply. It registered a positive demand of 5,251 BTC. And to put that in perspective for you, that was the highest demand reading we'd seen since the end of July.
So that's real money, not just short-term speculators.
That's what it indicated, yes. Real money was entering.
And we even saw that brief flicker of institutional hope, right? That multi-day ETF outflow streak, which had totaled about $1.2 billion.
Yeah.
It temporarily paused with a tiny, $1.15 million net inflow?
A tiny little green shoot.
Right.
That brings us directly to the technical ceiling and really the defining institutional whipsaw of the week.
Okay, the brick wall.
The rally just hit a brick wall. It stalled decisively. It tested, but it completely failed to break, the $107,500 ceiling.
And that wasn't a random number.
Not at all. That level was a very strong technical confluence of the 38.2% Fibonacci retracement and the 200-day EMA. When you talk about Fibonacci levels and EMAs converging like that, you're talking about a level where historical price memory and trend followers all basically decide to put up resistance. It was a massive psychological battleground.
And it wasn't just new sellers showing up. The market hit significant supply from the long-term holders, the so-called old money, who were taking profits pretty aggressively after that bounce.
Yeah.
Was that profit-taking really strong enough to derail a whole macro-fueled rally?
The data suggests it was overwhelming. I mean, LTH exchange inflows were reportedly double their normal levels.
Double.
Yeah, that $108,500 level was identified as the zone of just massive overhead supply. It confirmed this rally was being used as an exit ramp by experienced players, forcing all that new institutional money to absorb enormous sell pressure.
All right, let's get to that institutional flow reversal because it happened with just dizzying speed. We had one day of major excitement, a single-day inflow of $524 million into Bitcoin ETFs.
The largest since early October.
The largest since early October. So everyone's thinking, okay, here it is. This is the institutional buy signal.
And that signal was instantly reversed. The very next day, a stunning $278 million net outflow.
Wow.
You have to wonder what the conversation was like inside those institutional funds, you know? They bought heavily on Monday only to panic out on Tuesday. That dramatic reversal just immediately supported this whole narrative of institutional fatigue, a total lack of sustained conviction in that specific vehicle.
And then the macro certainty didn't even help. The successful final signing of the bill to end the 43-day government shutdown became the classic.
Sell the news event.
Yeah,
absolutely. The removal of uncertainty just prompted this capital rotation toward less risky traditional assets.
We saw the Dow Jones close at a new record high.
Exactly. It signaled that capital was moving towards equities and away from digital assets as soon as that uncertainty was resolved.
So this technical failure and the flow reversal,
Mm-hmm.
they triggered the inevitable consequence, which was a massive deleveraging event. Total liquidations reached, what, $643 million?
Across the network, yeah. And if the core conflict is fast money versus strategic money, this liquidation event was, well, it was necessary pain for the fast money.
So?
Approximately $530 million of that total was long positions. So that means the leveraged bulls, the people trying to ride that momentary rally with borrowed money, were completely wiped out.
It cleanses the market.
It cleanses the market of excess risk, yeah. It creates a better environment for that strategic capital to come in later.
But that cleansing wasn't enough to stop the collapse. That really set the stage for the structural breakdown. The key psychological floor of $101,000, it failed to hold. It just accelerated the sell-off.
And the price smashed right below $100,000, establishing new 6-month lows down near $94,500.
So once that $100,000 psychological level failed,
Right.
it immediately flipped, right? It went from being a floor to being the primary immediate resistance.
Which is a huge technical event, a really big deal.
And analysts are already talking about the $80,000 region as the next major structural support if this selling pressure continues. How much of that is just technical extrapolation and how much is based on, confirmed fundamental selling data?
It's a mix. The technical chart absolutely mandates that that level is next. But the fundamental data confirms the severity of the supply shock. I mean, just look at the hard numbers confirming the institutional exodus.
Give us the numbers.
U.S. spot Bitcoin ETFs recorded their second largest outflow on record, a staggering $870 million in a single day.
$870 million. That really puts the institutional panic into perspective.
It does. And underlying that panic, the long-term holders were distributing massive amounts of Bitcoin. We're talking 815,000 BTC sold over the past 30 days.
Which is the largest sell-off since January.
Exactly. The largest since January. That created a supply saturation that the buy-side pressure simply could not absorb. And the result? Over $1.24 billion in crypto-wide long positions liquidated in 24 hours. That is a major, major market cleansing event that forces a structural reset.
Okay. That is the story of generalized panic. But here is the crucial aha moment, the core tension you mentioned at the top. Beneath all that panic, strategic money was accumulating with what looks like absolute conviction.
This is the institutional divergence in action.
It is.
Exactly. While all that fast money held in ETFs was sprinting for the exits, strategic capital was moving in to absorb that supply and to do it efficiently.
So who are these buyers?
Well, look at the specific cohort we track, the shark wallets. Those are wallets holding between 1,000 and 10,000 BTC.
Right.
This group alone accumulated a massive 45,000 BTC in the last week. They were acting as an unseen bid that effectively caught all that falling supply.
And we have specific regulated entities confirming this buy-the-dip strategy, too. The regulated U.S. custodian Anchorage Capital acquired 4,094 BTC.
Valued at about $405 million.
Right on the dip. This really suggests a direct physical transfer from paper holders like the ETF sellers to cold storage, long-term holders.
And the confidence even extended to sovereign entities, which frankly is remarkable given the price collapse. The Czech National Bank, a European central bank, made its first ever digital asset purchase.
That's a huge signal.
A huge signal. They invested $1 million into a test portfolio that includes Bitcoin, and they entered the market precisely at the 6-month low. It confirms that strategic, long-term interest is entirely unfazed by this short-term volatility.
But the rotation thesis is maybe the most compelling detail of the week.
Right.
Because on the very same day that we saw $1.13 billion in combined BTC and ETH ETF outflows.
A bloodbath.
A total bloodbath.
Yeah.
The newly launched U.S. spot Canary XRP ETFs, which trades as 6RPC, and we should note that's a very specific, often controversial altcoin focus. It debuted with nearly $250 million in net inflows.
That changes the equation significantly, doesn't it? The XRPC debut posted the highest day-one trading volume of any 2025 ETF launch. This tells us institutional capital isn't fleeing crypto entirely. It's specializing. It's moving away from that generalized exposure to Bitcoin and Ethereum and into specific, newly regulated asset classes. It's a calculated rotation.
So while the fast money was running to the exits, the infrastructure builders were just still laying pipe. Which brings us to our last segment. The long-term maturation of the market continued this week, completely ignoring the price chaos.
That's the key takeaway. I mean, despite all the dramatic volatility, the fundamental integration just accelerated. We saw SoFi Bank become the first U.S. nationally chartered bank to launch a consumer crypto trading platform,
integrating it right into traditional banking services.
Exactly. And U.S. Bank also resumed its institutional crypto custody services.
And the plumbing for institutional finance saw a major upgrade, too. BNY Mellon, the world's largest custodian, launched its Stablecoin Reserves Fund.
Right, a regulated government money market fund that's designed specifically to hold stablecoin reserves. That is essential TradFi plumbing that allows the big banks to interact safely with the crypto space.
And on top of all that, regulatory clarity made some huge strides. The U.S. Treasury and the IRS issued guidance that explicitly allows crypto EPPs and ETFs to stake their underlying proof-of-stake assets.
Which is massive. It's just massive because it transforms these products into yield-bearing instruments that could address a major institutional drawback regarding, opportunity cost.
And finally, on the regulatory horizon, new bipartisan Senate bills were introduced. These are aimed at granting the CFTC, the Commodity Futures Trading Commission, broad authority over digital commodities.
And that's significant because it solidifies Bitcoin's status as a commodity, which is a key long-term regulatory de-risking event. It provides certainty regardless of the short-term price.
So as we summarize the week that was, where do we stand?
Well, the immediate direction is bearish. That was confirmed by that second enormous wave of ETF outflows. So the bears are in control for the near term, but the accumulation happening underneath is fierce. The price is, for now, successfully holding that critical support band between $93,600 and $94,147.
So that's sustained accumulation at the lows.
It suggests that strategic players are successfully absorbing all this short-term panic distribution.
I think the major lesson you should take away from this week is that the institutional market is demonstrating a really strong bifurcation. The conflict isn't just between bulls and bears anymore.
It's more nuanced than that.
It's between institutional capital exiting the generalized crypto exposure via those massive ETF outflows we saw, and institutional capital specializing in specific areas, whether that's accumulation into cold storage by the sharks or that record-breaking rotation into the specific XRP ETF debut.
That's the new battleground.
So the thing you should be watching closely is this. Do we see that $80,000 downside target get tested? Or is this unseen strategic bid strong enough to finally exhaust and reverse the institutional panic? That's the question for the weeks ahead.